The first rule of investing is don't lose money. And for rule number 2, don't forget rule number 1. Earlier this year, I put a good chunk of my savings into Alibaba. I bought 100 shares in June for $211.47 per share. The price from there, it started dropping, and it really wasn't fun to watch. Although my investment thesis, it didn't change, and it was trading for an even more attractive price. So I ended up buying another 100 shares in September for $145.16. It bounced up briefly, but since we've seen it drop even further. Some of the recent downward pressure, it has been sparked by headlines around the delisting of Didi Global, as well as the VIE structure, which has always been a little questionable. Chinese stocks across the board have seen billions of dollars evaporate from their market caps. At the recent low point on Alibaba stock, I was down more than $13,000. That's really not a great feeling to watch some hard-earned savings vanish. But these are just paper losses for now. I still haven't sold my position, and the important questions: has my investment thesis changed? Is the risk to reward still looking good? Or should I cut my losses and sell my Alibaba stock now? I'm not going to rehash my entire thesis here. You can check out my original video for that. It's really packed with some useful charts, and I've linked to it down below. Instead, I just want to give an update, and I'm going to give some more detail on a few of the points that I've already touched on. The biggest risks I see, as well as the huge opportunity ahead. And as always, I'd really appreciate it if you just tap that like button down below, because that helps out with YouTube's search algorithm. Also, thank you to everyone that's already subscribed. You can also tap that bell button below to turn on notifications. That way you can be the first to see when I share new research and investment ideas. So getting into it, as a US investor, one of the biggest risks with Alibaba stock is geopolitical tension. China has a very different system than the US. There's not really the similar checks and balances that we're used to seeing here. As a one-party system, the CCP has a lot more control, and we can see abrupt changes with the policy as well as enforcement. In the recent words of Ray Dalio, the Chinese government is kind of like a strict parent. And to be honest, I've seen this analogy used from other big investors as well. As far as the CCP's control, I saw some of this firsthand. About 7 years ago, I worked in Beijing. 我会说一点普通话。今天空气不好在 Beijing. Hopefully that was understandable if any of you guys speak Mandarin. Let me know in the comments below. And either way, I've gotten some unique insight into the news and media in different countries. I've been pretty fortunate to travel to other places as well. So in China, due to the internet restrictions, I had to use a VPN to access many websites, and many of the Chinese coworkers that I was with at the time, they had to do the same. The flow of information is more restricted, or said a better way, it's restricted in different ways. The US has many controls in place as well, and there's plenty of bias on both sides. Nonetheless, the geopolitical risk is high when factoring in national security on both sides, and some big moves are just simply used as political bargaining chips. The recent delistings, they're not great to see, and Alibaba could easily follow suit. But before I even bought my first position into the company, I was prepared for that possibility. I bought shares on the US exchanges, and if delisted, I should be able to convert them to the foreign listings. Investor sentiment is already low, as we've seen with Baba's dropping share price. But a delisting would push shares down even further. It's not fun to watch, but my long-term thesis, it still remains mostly unchanged. The recent actions from the CCP are sending shockwaves to certain industries and markets. Although limiting access to foreign investment on a large scale, it's a net negative. Of course, you can protect certain industries and help make them more competitive on a global scale, but it can often lead to retaliation and other less desirable side effects. I believe with some of these restrictions, China is doing more damage to itself than the US possibly could. By limiting access to capital, tighter controls on video games, etc., it's a less rewarding place for investors to set up shop and expand. This will push more entrepreneurs away to less restrictive countries. Even with the new restrictions and downsides, Alibaba, Tencent, and other large Chinese companies, they continue to remain crown jewels for the country. They help China compete on a global landscape, and it's a tough balancing act to regulate them without stifling too much growth. I'm sure we'll see some more fines and restrictions to really rein in the tech companies, similar to what we're seeing here in the US. And with Tencent's financial operations, I see bigger risk. That's one reason I haven't bought any Tencent shares. But with Alibaba, I'm hoping we're past most of the worst of it. Pressure on Jack Ma, the abrupt halt of Ant Group IPO, and the more recent $2.8 billion fine. And of course, a delisting, it wouldn't be great for the share price, but long term, Alibaba should still be able to continue growing with China's economy. Valuation-wise, Alibaba is still one of the best opportunities to invest in China's growth today. Just like any large government, there are plenty of Chinese policies I don't agree with, but what's hard to disagree with is the impressive growth of the Chinese economy. Over the past 3 or 4 decades, China has really shifted towards opening up to the rest of the world, as well as capitalism. And as we've continued to see throughout history, this is one of the best recipes for growth and raising the standards of living. It creates better incentives and opportunities for adding value to others and just innovation in general. Businesses only survive as long as they continue to add more value to customers, barring government restrictions, aka crony capitalism. And this survive or thrive rule based on adding value, it's actually the same for governments as well. But the feedback loop is faster when it comes to businesses. They can fail faster. With governments, huge inefficiencies can sustain for much longer, and they tend to end in bigger bangs. But I digress. China has already become the wealthiest nation in the world. In 2020, it had the highest number of billionaires, more than the US and India combined. And another fun fact is that at the start of this year, China had 85 female billionaires, roughly 2/3 of the world's total. China continues to grow at a faster rate on many levels. Based on many trend lines, China will continue to outpace the US. I wouldn't be surprised to see the renminbi take over as the world's reserve currency within the next few decades. There's a really good possibility of that happening, and maybe sooner than later. So all this, does it really play into why I worked in Beijing and learned some Mandarin? Yeah, but either way, the continued growth of China, it really bodes well for e-commerce businesses like Alibaba. With beaten down Chinese stocks, it's an even better time to buy in. For one more piece of wisdom from Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. China, it isn't disappearing anytime soon. And with Alibaba stock, you can get a much better price than I got, as well as Charlie Munger. Of course, it's going to continue to be a very bumpy ride, and the investment, just like any investment, it might not work out. But adding some exposure to Chinese stocks might be one of the best long-term moves today. I hope you found this insight useful, and here's my original video on Alibaba stock that I mentioned earlier. Also, I'd really appreciate it if you just tap that like button down below, and also please let me know if you have any questions in the comments below.